Hello and welcome to The Resilient Investor, the second episode of The Resilient Investor. My name is David Stevenson.
And I am Sam Ridley. Pleased to be here.
And together we are The Resilient Investor, and our mission in life is to try and help sort of beginner investors, novice investors, maybe younger investors, think through how to survive turbulent and volatile markets. And they've been turbulent and volatile again.
I have indeed.
But they went up massively yesterday, and sadly going down again today.
I think certain stocks are on steady course down after earning reports. I feel very much like a kite in a storm at the moment.
But Meta, I think Meta's been bashed, hasn't it? So we're living through kind of turbulent times. It's very easy to lose track of certain basics. But what we are going to talk a bit about today is we're actually going to sort of step back from where we did the first episode. And we're going to talk a bit about what it is that we invest in, the kind of things that we actually do. We're also going to talk, or at least I'm going to talk a bit about the importance of risk and how you should love risk. That's not the game, that's risk as in stock markets. Sam, you've got an idea, have you? You're going to talk about?
I do for this week. I've brought esports and video gaming to the front of discussion. It interests me greatly, and I think it's a booming market with a long road ahead.
Absolutely, and I'm going to talk a bit about quality stocks. And actually, funny enough, I was going to talk a bit about Microsoft, which is one of the big gaming stocks, and has been reporting this week actually good numbers. So we're going to that's what the outline of the next half hour, and we're going to start off though with the $64 million question. What do we invest in, Sam? What do you invest in? Talk us through what you do and how you invest.
Yes, and please. No way, shape or form is this advice, because I've been through quite a turbulent last 2 years. So this is more of a confession, I suppose, David, more than anything.
Oh, I do feel like your investment priest now. Come into the booth and I shall hear your sins.
Yes, and there's a lot of them.
Oh dear, right, fair enough.
So, how do I invest? What do I invest? Where?
So first of all, which accounts do you use? So do you have an ISA? Do you have a pension?
Yes.
Which accounts do you use?
I've got 3 accounts with Hargreaves. I've got a SIP, company SIP. I have a stocks and shares ISA, and I have a fund and share account, which is for international listed stocks that aren't available through the stocks and shares ISA.
Okay.
Primarily Asian stocks.
Asian.
Yeah. So NEO and C, the Southeast Asia commerce leader.
Yeah.
I can't access them through my stocks and shares account. They can only be bought through the fund and share account.
All right, okay. And what's your big holdings?
And free trade as well, I should say.
Free trade. So
I also use free trade. And then I've also got a free trade stocks and shares ISA.
Okay, fine. And what do you use each of these accounts differently? Do you you've already said you use your ordinary dealing account for Asian stocks. Do you use your main SIP for boring stocks or exciting stocks?
My SIP is long hold strategy. So I've got a Vanguard Life strategy, 80% equity.
Yeah.
Fund that takes
good,
up
good
16%
good idea. Absolutely.
of my SIP. Then I have a couple of long-term company holds. Disney being one.
Yeah.
I've got a Scottish Mortgage Investment Trust that's taken an absolute battering, but nonetheless...
That's done really well in the last year.
It was a hell of a roller coaster. We went right up. It was a star darling for me, and then it's gone right down, and it's on the naughty step. So it's been a love-hate relationship with that investment trust, but I have faith. And so the SIP is longer hold, longer horizon for me. The stocks and shares ISA with Hargreaves, which was my first account opened as a stock share account, is quite mixed. 60% international shares, 30% funds, that includes unit trusts, OEICs, ETFs, and then 10% UK shares.
Right.
So it's very international heavy, quite tech heavy. I'll go through some of the names, I'm sure, in a moment. My free trade account I opened with a deliberate motif to be UK shares.
Okay, that's interesting.
And it started well, and I've still got some of those UK shares in the free trade account. But then as growth began to pick up and I saw lots of opportunities and I could only put so much into my stocks and shares account in Hargreaves, I started to play around with the free trade, and it began to incorporate some growthy techie stocks, which went against my original investment strategy and it's now stung me. And that was the FOMO.
How do you mean? What's gone wrong?
Well, just that I moved money around, broke my horizon kind of rule. Companies that I was looking to hold, UK businesses looking to hold for 6 months to a year, because growth was up and up and up, and I wanted to make use of the stocks and shares kind of ISA limit. I slowed investing into UK businesses, started to invest in a few growth stocks, and we're now well down on investment on those positions. When if I kept to my strategy of UK, they haven't gone down nearly as far as the tech stocks that I invested in. But that was greed, FOMO, emotions mixed into one.
So if I could characterise it then, and how old are you? I know a lady never reveals her age, Sam.
Indeed. I am 31, soon to be 32.
So you've got another kind of 35, because, well, actually, by the time you retire, it will probably be 82. But at the moment, it's 67, I think, or it's about to be 67. So you've got another 35 years. So you've got a long time horizon. And can I characterise you've got kind of like 3 pots? You've got a kind of boring pot, which is Vanguard Life Strategy.
Yep.
You've got a kind of quite a big lump, by the sounds of it, of growth stocks. Yeah.
Yes, I'm very risk on.
Yeah, which is good for your time horizon. We'll come back to that. And then you've got a kind of pot where you play around in, which has got shorter term horizon. Is that right?
Yeah, indeed. That's where I try and identify high growth small caps that have a kind of potential.
Okay.
And also make use of opportunities in real time. So, if big businesses become on sale, like we're seeing a few at the moment, I would look at an entry point, hold, and then if it becomes something or there's reason to continue investing, I'll DCA that particular holding up, and then it becomes a main
DCA, you mean dollar cost average? You just put a bit of money in every month.
Dollar cost averaging.
And do you put a bit of money in every month to each of these accounts?
Yes.
And do you buy regularly each time in each of the accounts?
I do. I'm not very good at holding cash.
Yeah, well, that's good. Nor should you, I think. So that's yeah, okay. And what's a couple of other quick questions? It feels like a confessional, as you say. So
please, I'm feeling lighter already.
Unburden your sins, son. So what's the single biggest, apart from Vanguard Life Strategy, which is a fund, what's the single biggest either single stock or ETF that you own?
Microsoft.
Oh, good. Well, very wise.
Microsoft is 15% of my Hargreaves Lansdown stocks and shares ISA, so it's a very large holding for me.
I'm going to bring in my idea of quality stocks, because actually, as we're recording this week, Microsoft brought out their numbers. I think it was yesterday.
Yes.
And they're really good numbers. And one of the things is, if you're going to pick a stock as opposed to a fund, you're ticking one of the golden rules, I think, which is if you are going to individually stock pick, it's really important that you pick quality companies, in my book. Yeah. And what do we mean by quality companies? We mean companies that have got growth prospects. Yeah. That are in growth markets, but that are financially sound. That means they're profitable, producing lots of cash. And you shouldn't get too worried maybe about overpaying for them. What do we mean by overpaying? Shares quite often have what we call multiples, and I haven't looked at what Microsoft's multiple is. In fact, I will do it now as I speak. And so you shouldn't be too worried about overpaying for these, because the reality is, if it's a really good company and it's growing quite well, then you should be perfectly happy to pay a quite high price to earnings ratio. So I'm looking now at Microsoft, and I'm looking at its P ratio. And as we speak at the moment, it's trading at roughly about 26 times earnings. It has traded up. So what that means is, for every pound of or dollar in this case of earnings, the share price is 26 times that. Yeah. And it has traded up to, as high as 46 times earnings, yeah? So it has traded a lot higher. And it's traded all the way down, actually, to single-digit PEs in the first part of the last decade. But the reason why it's now about 25 times, it's a good stock to hold, I think, is because it's very well run. It's resilient in a recession, because we all pay our Microsoft Office subscriptions. We all like to play the games, which we'll come on to. It's phenomenally cash generative, and it's just generally an all-round good business. And it's been through the regulatory kind of bashing, and it's come out the other end, and now it's probably laughing as Alphabet and Meta get kicked around. So I think it's a good top stock. So Sam, what's the worst single biggest loss you've made? Come on, time for confession.
Well, it would be, and it certainly solidified its position as that yesterday, Teladoc Health. Which is a health business that acquired a business called Livongo a few years ago, and at a very expensive price. And yesterday it did its earnings report and actually had a fairly good earnings report. But because it's repaying or has a repayment scheme in place because it overpaid for Luongo, and I'm not quite sure on the technicals of it, but it has to pay back in the billions. It's already paid back.
Yeah, that's right.
10 billion at the moment. 10 billion at the moment. It's being penalised for that, and its share price 24% pre-market before markets open today down.
Oh, and by the way, it has been going down for the last couple of months. A couple of months ago, it absolutely cratered as well.
I'm 70% down in that one stock alone.
Okay.
And so all I can do is say a little prayer for it and hope that we get back.
This comes back to my point about volatility. It's nice we're wrapping this all up in the conversation. I'm a great believer. People say that risk is a bad thing, and risk is a bad thing if you've got a short time horizon. So you shouldn't really invest in shares or use your capital to invest in shares if you've got a time horizon of under 5 years. And what that means is, are you going to need the cash in the next 5 years? If you are, you shouldn't invest in equities. You've got a 35-year time horizon, and volatility is your friend. And actually, my golden rule is, if you've done your research on companies you really like and you really rate them and you think they're great companies, you should actually embrace volatility and buy more of them. So if you really believe in Teladoc, which is big in telemedicine and was a big Scottish mortgage holding, so you are were doubling down because Scottish Mortgage are quite big owners of it. If you're that convinced, is
there a way to triple down, David?
Yeah, probably. Yeah. I'm sure you'll work it out. Yeah. Go work for them. Yeah, get on their share option scheme. If you're really that convinced, you should use volatility and actually invest a lot more. There's a fund manager I know who's a very value orientated fund manager, and he's very successful. And when he does his research on companies, not your kind of companies, not tech companies, he's much more interested in boring kind of value companies. He will quite often top up as the share price falls, because he thinks, you shouldn't really care about day-to-day prices. It might go up 10%, might go down 10%. If you really believe in the company, you should invest in it. And you should use volatility, as a way of actually leveraging your position, building upside. So are you that convinced about Teladoc, or is the market trying to tell you something, Sam, which is it's shit?
I'm convinced. I do believe in telemedicine and the power and future that will bring, particularly to parts of the world that can't access medicine easily. And so I believe the business case, but how the business is being managed, question marks perhaps. And no, I'm still a believer in them. I'm not actively buying even after today's 24% drop, although it has triggered a thought. Good question. I have had been trying to identify new businesses that sit outside of my current portfolio that I don't have in my grasp at the moment that are also on sale. Mercado Libre being one, the e-commerce player in South America.
Yeah, good company.
And so I've just been divvying up my funds, if you like, in a different way. But you raise a very good point. 24% down in a single day. If I still believe in the business, that is bargain basement territory in my eyes. But could it go further? That's what I'm always concerned about. How do you know when to?
I mean, almost certainly in these markets. It's a fool's errand to try and work out where the bottom of most shares are. I think it's not a fool's errand to work out where the bottom of markets can be. You can get a rough understanding of it. Okay, and you've gone very growthy, very international, which I think international is a good thing to do. So, and actually, you said about 10% UK equities are one of your thing, and I think, by the way, that's about spot on. If you look at UK stocks in the universe of developed countries, it's actually only about 5%. America is 65%. So that's good. So you tick the international diversification box. What about that? You're a bit growthy. What do we mean by growth? You've got a lot of tech stocks in there that are were doing very well. They're probably not doing as well in that moment. Why are you not mixed your styles up? So there's growth stocks, tech stocks, so there's value, boring, cheap companies like oil companies, for instance, or airlines. Have you got any of them?
Yeah, I've got Wizz Air airline. Although
very useful for going to Hungary, yes.
And they put a lot of work in through COVID in mapping out expansion, Middle East and Africa particularly. And I see feedback ratings for many Wizz Air users, and they seem to be doing a good job, much like Norwegian Airlines has always been in my book. Great airline. to plug. So I've got Wizz Air.
Yeah, pity about their American roots, but anyway, carry on.
Yeah, I know. As I say,
Move on quickly.
No, so yeah, Wizz Air airline for me. Exxon from a oil perspective.
We'll just pass over the ESG angle on that one, but let's move on quickly.
Yes, yeah, developing investor as well as trying to become a resilient one. So I've got a couple of oil stocks, got an airline, got house builders, Vistry Group, another UK stocks. I've got General Motors, obviously not quite tech, a bit more value orientated from a US perspective.
And what proportion of your individual stocks do you reckon are value orientated? You won't know exactly, but do you think it's a tiny proportion, 10%, 20%, 100%?
Yeah, I'm thinking 15% of portfolio is value.
Okay.
Compared to the rest being growth, tech. I've got a small holdings towards crypto, both in Crypto Direct, but also via Coinbase. Well. Yeah. It's taken another pounding lately, but and then I've got my topic I'm coming on to later. Video gaming, esports. I'm a big believer in. And
all right, we'll come back. So shall I? I'll go through what I do. So
yes, please.
I'm a bit like you.
Let's get my pen and paper.
It's not. I'm not that good. I've got, like you, a couple of accounts. So very similar to you, I have a kind of core account, which I have with an outfit called Killick & Co., which is a wealth manager stockbroker. And I've stuffed that full of, probably a bit like you, very boring stocks. Yeah. A mixture of both boring value stuff and investment trusts. I like investment trusts, which I spend a lot of time researching. And then I've got sub-growth stuff. So I've got Scottish Mortgage in there as well. So I've got that kind of core portfolio. And then which I run for my SIP. Yeah, that's with them. I've also got one ISA with Killick & Co., which again is very boring, full of really boring stuff. Very, actually quite value orientated. And then I've got a free trade account like you, where I actually, funny enough, that's quite UK focused and is actually quite at the moment very heavily in fairly boring stuff. So I've got a big hedge fund called BH Brevin Howard, which is listed on the market. I always get it wrong. BH Macro. Very big hedge fund, which has done actually phenomenally well in the last 6 months. It's done very well for me. And I've got some other boring stocks in there, like a mining fund, BlackRock World Mining, which is an investment trust. And I've also got some energy efficiency funds in there. So for full declaration, I'm a non-exec director on one called Gresham House Energy Storage. So there's that kind of second pot. And then, like you, I've got a kind of play pot. And my play pot, not clay pot, play pot, is with IG, because IG have got a brilliant ISA account where if you did in American shares, they don't charge you any charges, and you can invest in all American stocks, not like free trade, which is free, but you have to. You're only a limited number of US stocks. With IG, you can invest the entire American market entirely free in an ISA, which is, I think, a pretty good deal.
So free to make a trade, or free of the FX exchange rate?
And the
charge?
FX exchange rate is very low as well. I can't remember what it is now, but I think it's down at 40 or 30 basis points, so it's quite low. So it's a very, very cost-effective account, and IG is very good to trade on. Free trade is good to trade on as well, but IG's got lots of super tools and that kind of stuff. And that's my kind of play area, and that's American stocks. Although at the moment that's quite weighted to kind of what I call quality stocks. So I've got names in there like, I've actually got a mixture of things. I've got Microsoft like you in there. I've got Nvidia like you in there. I've got very long Spotify, which I think is a fantastic business. But I've also got really boring companies in there like Freeport-McMoRan, which is one of the world's biggest copper producers, has gold interest as well. Newmont Mining. So I've got a mix.
David,
yeah, go
on. In that play pot, the playpen, which sounds like my main pot. It's quite funny, really. How frequently are you trading?
Probably every month. But I will keep a position open. So Microsoft I've had for 5 years in that account.
Okay.
And I add to it, like you do, I add to all of them on a monthly basis. And I will add to, I'm pretty methodical at just adding to my main positions. I equally weight the position as much as I can.
Yeah. Yeah.
What I mean by that is, let's say I've got, I don't know, for argument's sake, £50,000 in an ISA, and I've got 10 stocks in there. I'll try and make sure £5,000 in each stock. As I add money, I will add it equally every month to each of them. So I'm quite careful on that. And and I will play around with stuff. So, for instance, I invested in Compass Pathways, which is one of the world's biggest psychedelic companies. We talked about psychedelics last time, and I put money in there about 2 months ago now, and that's doubled already. So, and then I'm quite aggressive in that pot of taking profits. So, if something doubles, I will take about a third off and just reinvest it in something else. Usually, the other things in the portfolio. Sorry.
That's very interesting, David, because I'll rephrase. I have rarely taken profits. And I think for me, it's because some of the ISAs I haven't had for 5 years, it's been maybe 3 years. And that time, just before COVID and market drop, then there was a spike in me buying. Then I rode the wave up to the top, euphoria, happiness, soon to be retiring thought. And then very sharp decline, and now retiring at 95. And so I didn't take profits. I don't cut at losses. And I feel that's part of investing that I sometimes feel a bit in no man's land with, is it's either timing when to buy or when to sell. And I seem to be doing neither. I'm hodling to all the crypto fans.
I don't think, exactly. I don't know any golden rules or hard and fast rules here, but I think that rebalancing your portfolio on a relatively regular basis, maybe every year, will do you no harm. And I think that if you've got a series of good ideas, so in my American portfolio on IG, for instance, I tend to keep it to about 10 or 12 stocks. And you can't do the research on 10 or 12 stocks all the time. I tend to equal weight them. I tend to think I'm trying to put equal amounts of money in each, because I'll keep up with them, but I can't keep that much up with them. And then in terms of taking profits and losses, I think in a sense taking profits comes with that equal weighting, because if you allow one stock to get vastly out of proportion, you're not equal weighting everything by default. If one stock goes from 5,000 to 500,000. That's literally going to be dominating your portfolio. And I would progressively take profits personally, and a kind of, when something doubles, I take about 30% off. When it doubles again, I probably take another 30% off. On sticking with losers, I actually better at sticking with losers, because if I've got my 10 or 12 stocks and I still like them and they go down, I tend to take the profits of the successes and reinvest them in the losers. So I took a bit of.
I was going to ask that. Okay, fine. That's where you reinvest profits.
Yeah. If you like the company, so for instance, literally this week I took some money off the table for Compass Pathways, which I think it's a great stock. I think it would do really well. I just took about 30% of it, and then I reinvested it in Meta and Alphabet, which I thought Meta. I think everybody's beating up on Zuckerberg and Meta at the moment. I still think it's a fantastic business.
Isn't it their first losing quarter in their history in terms of revenue climb? It's the first time it's happened. Absolutely. So is that feels like an overflamed drop and will recover? The business is still.
Yeah. I mean, it's still if you look at a lot of the user metrics, they're still going up. We bring developed world or US and UK perspective to everything, but in the developing world, Facebook and Instagram are still doing very well. So and it's a cash cow. Same with Alphabet. Alphabet had better numbers, and Alphabet is just increasingly a quality stock. It just compounds out money, because no one could come near it in terms of advertising spend. So I bought more of them. It did help that Alphabet had a 1-for-20 stock split as well. So I'm quite ruthless about taking profits and reinvesting them in my losers, so that I try and keep they're all roughly equal in the portfolio. So that's the way I run money. So just like you, I have a play pot, and then I have a kind of core portfolio where I barely do anything to. I think with my Killick one, I'd be surprised if I do 2 or 3 things a year in it. And most of those are ones where I'm on the board of a fund and I have to, I buy the shares because it's the right thing to do. So actually trading is almost non-existent in them. So that's the way I play it. And I think you've got the building blocks of a really good portfolio there. You've got your time horizon is a long time, and therefore you can take risk by going into more growth orientated stocks. I think you're probably a little underweight value. I think maybe you could have a bit more value. I'm not saying go all in for value, because value could go bad for a very long period of time, and you underperform for a very long period of time. I think you've got some good quality stocks in there. So if your biggest position is Microsoft, I don't think you're in a bad place. So go quality, long time horizon, but I think the crucial thing for you is embrace risk. Yeah.
Yes.
I think
I am.
I think I think too many people of your age run away from risk. There was a very interesting study done by Nest, which is the auto-enrollment people, and they auto-apprenticeship people, and they found that a lot of people in their 20s who started investing, when they had a big loss because the stock market went down, they actually stayed away from investing because it put them off for life. And
I saw that.
Yeah, it's actually the wrong thing to do, because you should actually, it's the reverse. You should just realize you've got 25, 35 years, and you could afford to take volatility, and you could afford to use it as an opportunity. So that's what I would say. So what's your investment idea, Sam? Esports, gaming.
So I'm very interested by the esports and gaming industry. And to caveat this, one of my ETFs I hold is ESPO, VanEx, Esports and Video Gaming ETF.
Yeah, that's an exchange-traded fund traded in the London market, and it invests in a basket of gaming companies, esports, and associated businesses.
Yes, exactly that point. Couldn't have said it better myself, David. So it is a good holding of mine. It's declined in recent months, but I believe in it. It's got some great businesses in there like Nvidia, Activision, Zynga, EA Sports, to name but a few in the video game industry. But esports and gaming as an industry, certainly started at early 2000s in Southeast Asia, and it's grown and grown. And through 2010s, it's gone to a much larger audience in North America and Europe. Nvidia estimates there's well over 2.5 billion gamers worldwide now, and esports as a global audience is approaching 500 million. So these are big audiences already at a time when technology will only allow us to connect more and bring wider parts of the globe together that don't have access at the moment to watching esports or video gaming or streaming. So I think it's a massive audience market, and being from information and media as a business, I believe in the power of audiences. And so that's always captured my interest. The value of money, the amount of money within this market is quite astonishing.
Yeah.
So to put some numbers, which is what's really attracted me to esports and gaming from a long-term growth risk-on horizon to all of our points we just discussed. In esports and video gaming, there are now franchises that have been created. There's a list of, well over 50 businesses that are global that bring together esports and gamers and streamers, and they try and grow their brand, win at gaming competitions, franchise, create products, clothing products with emblems and logos. So it's like a league, if you like, of top franchises. And these businesses, the top 10 hold, or will be holding soon, I believe, if I just quote myself accurately, the total valuation of the top 10 esport organizations this year is $3.5 billion. These businesses over the last 18 months have jumped in revenue-making size. Top three, 55% up, 94%, and the most improved esports gaming, 100 Thieves they are called, have jumped 142% in revenue and value to now $460 million as a franchise, as a business, as a team generating revenues through their esports and gaming platforms, through their followers. It is huge money. And I think we're just at the tip of the iceberg because of the fact there is still so much, particularly in emerging market regions of the world, that still aren't connected or cannot get connected but want to and hear about it. So I think money-wise, it's proven that there's lots out there. It's in markets that I understand. It's biggest in North America, Europe, and Asia, and Southeast Asia particularly. And so as an industry, I want a piece of that pie. I want to invest in businesses that are going to directly benefit from this growth in esports and video gaming and the audience number that I think will continue to increase. And it's a generational thing as well. So I think it's got legs. And there are ETFs and shares within, or stocks.
Yeah, I was going to ask you that actually,
markets.
Sam. Why did you choose an ETF as opposed to an individual stock? So I should say Sam is the managing director of ETF Stream, so naturally knows a bit about ETFs. But why an ETF versus, I don't know, buying Nvidia or buying Activision or buying?
So at the time, funnily enough, this was kind of through the COVID period. I was just learning about esports and gaming, taking an interest, and I wanted a way of diversifying across a number of businesses within this kind of area. I didn't have the funds to cover all the businesses the way I wanted, and so I did my research via ETF Stream and realised that at the time, VanEck had an esports gaming ETF usage.
That's right.
Nice and easy. 25 holdings within the ETF, has large cap businesses, so your Nvidias, your Activisions, and it has smaller gaming companies as well. Bringing through like Zynga, and it just really interested me to be able to invest in the industry as opposed to a single stock. Now, what has happened since that time is I have invested directly, which you might say is doubling down again, and this is a theme for me, but I have invested in Nvidia. I did invest in Zynga before their acquisition. EA Sports, I have a small position in. I obviously have Microsoft. And there are other businesses that you can invest in, to get in on the ecosystem that isn't directly related to the gaming side in terms of playing, but, headset creators, Turtle Beach Headwear, which is basically what creates the gaming headsets that people would wear to speak to. So you can get into businesses that are, to do with esports and video gaming, but not directly related. And so, the ETF was a good starting point for me. There are other ETFs out there. There's Global X's video games and esports ETF. That's Hero for the global, or Hero ending in U instead of O, which is the UCITS version. That again has a broader holding number, has 40 businesses rather than 25 that VanEck invests in. So if you want slightly broader exposure, then Hero would be a good choice. There are ETFs out there that are capturing this momentum train, and I think it's a good market. There's money, there's liquidity, there's growth, all the things that attract me as an investor. And I have an understanding. It always helps, I find, being a private investor.
It does help to invest in what you do. Yeah, exactly.
Yeah, playing FIFA, playing Call of Duty, things like that. Yeah. That meant that I have an understanding of the power of these brands. And I was a loyal Xbox 360 online subscriber, so there'll be many more like me.
Okay, so in the last minute, I'd say, I'd say, it's sitting in my confessional. Well done, son. You're okay. Because I actually own exactly that ETF myself. Is one of my in my play portfolio.
That's Espo. You're talking about the VanEck.
Yeah, the VanEck. I've got the VanEck one. Yeah. So I've got the VanEck one, just like you have, and I buy exactly into your logic, and that's why I've got Microsoft and Nvidia. One of the reasons I've got them, so I sort of echo what you say. I haven't found myself buying any more of them. Yeah.
Okay.
At the moment, because I still think valuations are a bit elevated. I'm happily buy more Microsoft, and I'm probably happy to buy some Nvidia. But I'd probably not buy the ETF, the VanEck ETF, just at the moment. I haven't got any more. I haven't bought any more. So I think it's a really good idea. And I think for long-term investing, having a pooled approach via a fund, in your case an ETF, if there was an active fund, you could do that as well. But I don't think there are any.
David,
yes.
I have a question, very quick one if you don't mind. I know we're coming to the end of our episode. And it's kind of related. So Microsoft mentioned at the beginning, going through an acquisition deal about Activision Blizzard, which is just on ice at the moment, I believe, isn't it? It's under scrutiny, or going through the rounds of being approved. When something like that happens as a private investor, and you have both stocks, Microsoft I own, Activision I own, and Microsoft will buy Activision, just for the readers out there that might not have gone through this before. What happens once Microsoft goes through and acquires Activision?
Well, one of two things is either A, they give you shares in Microsoft, if that's what I can't remember what the Activision deal is now. They either give you shares in Activision, Microsoft, or they give you cash. Yeah. Okay. So there'll be a cash
value of
there'll be a cash settlement, or there'll be a stock settlement, or there'll be both. Yeah. And there'll be and there's big clearing houses amongst the stockbrokers, all of them, that do all of that in the background, so you never know what's going on. It's just the same with Alphabet did a 20-for-1 stock split. So 1 minute it was worth, I can't remember what it was worth, $1,400, then it was worth $70, and it did a 20-for-1 split, which it made its shares more affordable. And that was all done in the background, so you just got the new paper. So that's what will happen, Sam. It will get done by your broker, right? I think
within an ETF. Yes.
So with an ETF, they effectively just the same thing happens in the ETF. The fund manager does that themselves. They either get extra Microsoft stock, or they get extra cash, or they get both. We've run out of time. We've gone past our 35-minute boundary. Right. So this week, exactly. We've run out of time. So this week we've gone through what we own, and I think when our next episode comes on, maybe we'll go back and talk a little bit about how you think about international shares and how you think about domestic stocks and everything and American stocks. So we'll leave that to next time. Anyway, that's it from us. That's another episode of Resilient Investor. That's it from me. Thank you very much.
And thank you very much for tuning in.
And we'll be back in a couple of weeks' time. See ya.